Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Big Deal. While many deals are being struck under the IBC route, but remember, to avert a default situation and taking the matter to NCLT, some of the debt-laden companies are beginning to strike the deals ahead of a default situation. And one such significant transaction was this week between Tata Steel as well as Usha Martin. So Usha Martin, which has a debt of over 4,600 odd crore rupees, is selling its steel business to Tata Steel for a total cost of close to around 4,600 crore rupees, which will help it wipe off its entire debt, almost entire debt, and therefore strengthen their balance sheet to remain focused on their mainstay business of wire rope business. So that's a significant transaction. As far as Tata Steel is concerned, it's going to be a good alternative to Electro Steel steels, which they had bid for but lost out to Anil Agarwal's Vedanta Resources. So definitely scalable up to 1 million ton of long steel products, and in their turf, Jamshedpur, for Tata Steel, it's a good transaction. But there are many things that needs to be really understood, and the deal is not yet a done deal because it requires a shareholder's permission as well as far as Usha Martin is concerned. Remember, there's another faction of the promoter group with 25.5% stake, which has raised certain questions about this particular transaction. 75% of the total shareholders' vote is required for this transaction to be a done deal. I spoke to both the managements, Tata Steel as well as Usha Martin, first to the top team of Tata Steel on this transaction and everything around their steel business. My first question to you is, after Thyssen merger and that JV that was announced, then you had Bhushan Steel, now Usha Martin's unit. Is it the end of your acquisition spree in India? And are you also going to go ahead with Bhushan Power and Steel?
See, for us, this is a journey which continues. India is a growing market. India is an important market. And we said that last year that we would focus a lot more on India as we go about fixing the issues in Europe. And I think creating the JV in Europe creates an enterprise which is sustainable and can stand on its own. In India, the market is growing. It's growing at 7-8%, and we need to grow to keep pace with that market. These inorganic opportunities come to us at different points in time, and we need to be ready to seize it when it comes to us. The organic opportunities are more in our control, and we've continued to grow in Kalinganagar, as you know. So I would say that we will evaluate each opportunity for what it's worth, for its value, and take a call based on the attractiveness of the opportunity, our ability to go ahead with it. Obviously, we are conscious of our balance sheet and the debt on our balance sheet and what we can and can't do. But it is also, we believe, a good time in the cycle, and the steel markets globally and in India are quite strong.
But aspiration as far as acquisition in India is concerned, is that the end of that road, is what I wanted to understand, because at some time you had said that 26 million tons is going to be your aspirational capacity in India. You've reached that. Now, are you going to end here? Is Bhushan Power and Steel still on your table?
It is on our table just now, simply because it's going through the courts at this point in time. We will go through the process. We will cross the bridge when we reach there. But as of now, we are part of the process, and we will wait to see what the outcomes are of the courts.
All right. So, Mr. Chatterjee, of course, as far as balance sheet is concerned, and Mr. Narendran spoke about that, over 1 lakh crore rupees of debt already on your books, and this is this particular acquisition of Usha Martin's steel business is going to increase it further. Of course, 2.6 billion or 20,000 odd crore rupees will go as and when Thyssen Group JV will materialize. But what is your deleveraging plan from here on?
So I think, as Naren mentioned, we will look at each of these growth opportunities in its own merit and in the holistic manner as to where it takes us from profitability, value creation, and the balance sheet structure is concerned. So with the completion of the JV in Europe, we would be reducing debt by about 20,000 crores or thereabouts. That will be first step. Second is, if you look at the current level of earnings and cash flow generation, we have our definitive plans of gradually reducing our leverage while we are still going to grow organically in Kalinganagar. So we are looking at positioning ourselves on a net cash flow level after the growth, and I think the next 3 years we would be happy to maintain our balance sheet post the deconsolidation of the JV, use the cash flows mostly for the organic growth and for the surplus cash flows then to be deleveraged. And we're looking at parts of the portfolio also, which is also a part of an ongoing exercise. So I think the question is, if you continue to grow in productive assets, if you continue to grow in assets which gives you EBITDA and cash flow from day one, and have the ability to bring in synergies which may be proximate synergies, maybe structural synergies, our ability to leverage cash flows is most important. And that's the whole focus that we have today. So every ton of steel of new capacity has to be cash flow accretive, and that's our whole focus. As far as Usha Martin is concerned, when the transaction completes, I don't think that it's going to be a leverage transaction, because even in Bhushan, our marginal debt equity has been 50-50. We've put in almost 18,000 crores of equity in that company, which is not levered equity, pure equity. And we had about 17,000 crores, and we are seeing as part of the phase 1 of the integration, and based on the markets currently, that our cash flow generations are healthy on that. So similarly in Usha Martin, we will structure it in a manner that it doesn't cause stress either to that individual business or to the overall balance sheet.
So 4,600 odd crore rupees, is that going to be now on your books, and will the banks continue to have that exposure, and will the finance charge reduce, as is the case in most of the debt laden asset sales?
No, so this is an asset buy, this is not a company buy, and it is up to Usha Martin to decide what they would do with the proceeds. As far as we are concerned, whatever is the final adjusted closing number, we will be funding significantly through our internal accruals and cash, and we will see that how much is a more optimal debt that we need to put in there for tax and structuring reasons, but that's not going to be very, very large.
But you spoke about deleveraging. Can you give us some targets on what are the comfortable levels for debt reduction in absolute numbers and in terms of
So we've always maintained, it's nothing new, that we would like to reduce our debt to under 3, at or under 3 to EBITDA, and the reason why we keep saying this is we are also a growing company. We don't want to miss out opportunities of growth in this market too. So there is, and as I said, that so long we put in the marginal capital on productive assets, competitive assets and cash flow generating assets, I think we are comfortable, and we've kind of recapitalized our balance sheet earlier in the year with the rights issue. So I think the balance has been restored to some extent. The JV will restore it to another level, and our internal cash flows should therefore, be the base on which we should delever in the future.
We'll come more to the JV a little later, but Mr. Narendran, there have been some reports which have said that one fraction of Usha Martin's promoters may be not in favor of the deal that is being struck with Tata Steel, and they have a sizable amount of shares, 25.5%, and Usha Martin will require shareholders' permission up to 75%, the majority, to get this deal through. How confident are you? Have you had talks with the other faction as well?
We've talked to the company, and the board of the company represents all the factions, as you say. I think they've taken a call on what is best for the company, and I think it is, if they have differences, it is between them, for them to sort out. But I think as far as we are concerned, we've dealt with the company and we've got the backing of the board.
All right. And Mr. Chatterjee, as far as the capacity utilization is concerned and scaling it up, and also it's an underdeveloped thermal coal mine, how much more fund infusion is required for scaling it up to 1 million ton and also to take care of the mining?
So we've done our own estimates at this point of time, which requires some amount of capex to set the layout and plant as what we would like, and that estimate has been factored in our valuation. And the coal mine is a separate process, and once the transfer of the mine happens, we will do our own material balance of coal and figure out as to how do we actually kind of exploit or extract coal from that. So there is a phase 1 which is the process. Phase 2 would be the integration, primarily on the steel side, and then we will see how we can leverage our capabilities on mining to leverage the
I
coal
heard
mine.
1,000 odd crore rupees for capacity upgradation and also for coal mine.
No, that's on the higher side, more than the higher side.
Okay,
It
how
will
much
not
is the
require-
estimate?
No, I think it will be somewhere between 500-700 crores
Over?
over a 3-4 year period.
Okay. And Mr. Narendran, how will, economies of scale, and also Jamshedpur is your turf. Of course, this is a much smaller acquisition compared to what you have done and the size of the company in this country. But how will you scale it up, and how is it a strategic fit for you at this point?
I think the biggest attraction about this asset is it's a long products asset, and it's in specialty longs. So that's a part of our portfolio which we've been missing for some time, because we were in the forging quality business about 15 years back. This is a business where you sell a lot to the auto industry, with whom we have very good equity, and we have a very good relationship and very good business going with them in flat products. So this is a space in our portfolio which we were missing, so that way it's a good strategic fit. As you rightly said, it's in Jamshedpur, so managing it is going to be much easier than managing a site which is further away or on its own. We know Jamshedpur, we have the infrastructure, we know the ecosystem. It's adjacent to some of our facilities in Adityapur industrial area. That's a part of Jamshedpur which is also developing, because most of the auto component manufacturers are there. So I think in many ways it's a good fit. It's obviously a smaller enterprise than Bhushan Steel or some of the other acquisitions that we've had. So we were skewed more towards flat products with the inorganic and organic growth opportunities that we've described in the past. So this is a good addition to our long products portfolio, and at the right time, I think.
And how will you also be able to increase its profitability? Because I guess their margins are slightly lower than what Tata Steel has in Jamshedpur.
So there are many areas that we need to work on. One is on the operational side, to get the volumes up, because to me this is a plant which can produce at least 750,000 tons of steel, if not more. The blast furnace capacity is almost 1 million tons. There are synergies that we can leverage out of the raw material side, and even on the marketing and sales side. So there are many opportunities that we have. We are a very strong player already in wire rods, and this gives us another opportunity to supplement that. When I say strong, not in terms of size, because in size in long products we are actually quite small, but in terms of our understanding of the business, our relationships in the marketplace. So to me, scaling it up from a market point of view is not at all a problem. Operational point of view, the oversight and the support we can provide from our main steel plant, which is 20 kilometers away, is also very significant.
Right.
And I think there are a number of actions that we can take across the value chain, from the raw materials to the finished products, which we believe will help us unlock synergies and take the
And you're
operation.
taking over all the employees also?
Yes, in the steel division.
All
Yeah,
right.
yeah.
So, Mr. Chatterjee, coming to now the European side of the business, of course, operationally it has been doing well. The steel cycle upturn has really helped. But how are you seeing the impact of Brexit playing out on your entire joint venture plan?
So I think the terms of the Brexit are still not kind of clear, and I think if you look at the UK market by itself and our capacity, that fits in well if it's only a domestic. But the impact of the Brexit will play out on currencies, on tariffs, and on trade regulations and so on. So unless we see that in its totality, I think the most important thing, whether it is Brexit or otherwise, is to be competitive. And that's been our internal focus. Our management team and our colleagues are all working on ensuring that the plant and the business in UK in particular becomes more and more competitive. We've been on a journey of transformation. We've moved from -300 to around 100, 150. So we need to continue that. We will face headwinds as the Brexits come about in the context of many uncertainties, because the entire supply chain is facing uncertainty, whether it's the customers or the suppliers and so on. So as it develops, we should be able to adapt ourselves to the new normal, as we say, which we don't know at this point of time. But I'm sure that the JV management, which will actually integrate all the sites between Netherlands, Germany and the UK, will have to take that into account, and that's what we are all focusing on.
Is there any concern, and also is the entire JV process very much on track, because there has been a change of management at ThyssenKrupp group as well?
So there is continuity also, because the person who was leading the entire JV process, negotiation, continues to be the interim CEO. I'm sure that the board will take their own call when the things will be set in place. But as far as the process is concerned, there is no change. We are in the midst of the merger control review and application. So I don't think that has had an impact because the business continues to be strong. The management oversight on the TK board continues to be as engaged as ever. So I think the process should continue to its logical closure.
All right, and coming to India, Mr. Narendran, of course, steel prices have seen an uptake. This particular month, you have seen some price increase. Next month, you're geared up for more. How is the cycle looking? And in terms of performance, it's going to improve for this quarter as well.
Well, steel markets have been strong despite the fact that this is traditionally a weak quarter. In India, the demand has been growing quite well, I think, across sectors, whether it is automotive, which is obviously very strong, or construction, or railways, or LPG, or whatever. Any segment you pick, I think it's been positive growth. Globally, things have been quite okay. There have been some disruptions because of Trump's actions on Section 232, as well as what happened in Turkey and the lira. But generally, if you see, exports from China has been dropping month on month for the last 2 months. Okay. It went up till June, but it's been dropping, which gives some sort of balance in the international markets as well. So domestic demand is strong, and that's reflected in the fact that normally you don't increase prices in September because this is typically the weak quarter, but the market was strong, the stocks were low, and to some extent the rupee helped because a weaker rupee discourages imports. So imports which had been going up till June or July started dropping again. So overall, I think conditions are positive, and this is just the beginning of the season if I look at it from that point of view, because normally October, December is Diwali, and there are many other reasons for the steel demand to pick up.
Yes.
And Jan to June is typically the best quarter, best period for the steel industry, so in India. So let's wait and see. I'm optimistic about the next few months. A good time to acquire some companies, and which is what we've done.
All right, so you're emphatically saying that there is no end to your acquisition aspirations.
No, I'm not saying that. I'm not saying that. I think what I'm saying is we were very focused on what we wanted to buy, and I think we've been successful there. I mean, our original choice was electro steel, as you're aware, and we didn't get that, and I think Usha Martin that way is a good substitute for that, and it's closer home than electro steel was, though that was also in Jharkhand. So from that point of view, we are happy with both Bhushan Steel and electro steel, and Bhushan Power, we will cross a bridge when we come to it.
All right, and so you have played the role of a consolidator very well, as is expected from the bellwether in any particular sector. But final question to you, Mr. Chatterjee, of course, rupee depreciation, that has been creating havoc. Of course, for a global company, for you, it's beneficial in certain ways, but it also inflates overall loan figure that comes on your consolidated book. So net, how do you see the impact, and how do you see rupee going forward and impacting your company?
So as far as rupee is concerned, it has a very high correlation with the steel prices, and it's seen over a 10-15 year period. You can see that it's a correlation of almost 0.8, 0.82. So the impact, what happens is, if you have to take the net impact, it's essentially the cost of coal, which we import now almost 70%, versus the impact on the rupee and the demand conditions that exist in the local market. The balance sheet does get inflated because of the translation of the overseas debt. We don't have too much of debt on the India balance sheet, which is on foreign currency, right, but we have a large balance sheet overseas, primarily because of Europe. So that will get inflated, but so long as we can service that from the overseas cash flows, it should be neutral from a cash perspective. And we do undertake a fairly active hedging plan for managing cash, not necessarily for the translation part, because you can't manage translation. And that's why we figure out that if from a cash flow point of view we are net positive significantly, as Naren mentioned, then you are in a better space than being impacted on the cash flows and helping out on translation. So I think we are comfortable on that front. We'll see. The most important thing in the rupee is the volatility, not the absolute levels, because the absolute levels, once it reaches and trades in a range, it's much better or much more stable. The volatility is what creates a problem, because we buy coal, we sell, we have exports, and then you have to manage it more actively. So that's where we are watching, and we are always kind of on the watch as far as the rupee movement is concerned.
All right. So rupee volatility is a bigger concern. The uncertainty, if it stabilizes at whatever level, then you'll be much more comfortable. All right, gentlemen. Thanks so much for sharing so much of information about the company, and congratulations on the deal that is struck. Thank you.
Thank you very much.
Thank you.
Welcome back. You're watching Big Deal. As promised, let's take it straight across to Usha Martin's management on what the deal with Tata Steel means for them and how are they going to strengthen the wire rope business going forward. Mr. Jawar, you are a debt-laden company now. With this transaction, are all your debt woes really sorted? And how will you then expand your remaining business of wire rope?
You see, the total debt is around 4,500 to 4,600 crores, including the long term as well as all the working capital. With this transaction, the company is expected to repay almost all its debt. With this, the wire rope will have a very strong, the residual company will have a very strong balance sheet with an annual EBITDA between 250 to 300 crores on a consolidated basis. And this is a business which we can grow. We have been a global leader.
How will you grow this?
The wire rope business, Usha Martin has the leadership position in the country, and we're among the top 4 players in the world. Last 3 or 4 years, we could not invest in this business because of the over-leveraged position in the company. With this, we will be able to expand our wire rope and wire business as there would be very good cash flows being generated.
What is in it for the present shareholders of Usha Martin after the sale? Of course, the debt levels are going down, but in the present business, why will a shareholder stay invested in Usha Martin stock?
Because you see, today, I think once the company is totally deleveraged, it's going to be a debt-free company with a global leadership in the wire rope business, with an opportunity to have a good growth over the next 3-4 years. So we expect a good growth both in terms of our top line and the bottom line.
Any targets for that?
I would say at least we can grow at the rate of 15 to 20% per year. It may take a year to build up the capacities in these areas, and I'm sure that that would really be then on an ongoing basis we can expand and grow at this rate over the next few years.
So 60% of your revenues are going in terms of EBITDA. How much are you letting go of, and was it loss-making on a standalone basis?
The steel cycle has improved, and over the last 2 quarters the company has had a turnaround and has able to improve its bottom line both in the steel and the wire rope business. And we thought that it would be a good opportunity to sell the steel business at these levels so that you can
get better valuations.
Better valuation and able to totally deleverage the balance sheet and then have a solid rope business which you can grow.
Did you preempt an NCLT kind of a process, and before that you went ahead with an asset sale? And how will the lenders benefit? Who are the lenders? Is there any haircut?
The company Usha Martin has never had any default, and Usha Martin has been able to meet all its commitment to its lenders. There is no provisions which have been made by the lenders, and we have been totally current on our repayments of both interest and principal. Our main lenders are SBI, ICICI, Axis, Exim, along with few others, and they are very happy to see that the company has proactively taken this step and would be able to clear all its debt, and the company expects that going forward it would continue to add value to its shareholders.
Any haircut?
There's zero haircut expected for the lenders.
All right. Thank you so much, Mr. Jawar, for joining us.
Thank you.
This looks like the beginning of many deals on the sidelines of NCLT before it really hits NCLT, where the overall value really gets depleted, and it's a long-haul process. So many more such transactions needs to be seen. With that, it's a wrap on Big Deal edition for this week. And stay tuned to CNBC TV18. Thanks so much for tuning in.